once again to Pro Accounting Academy. This is your CPA Imani Kuewa. In today's video, we are going to look at how we can summarize our financial transactions. I talked about summarizing when I was giving you the definition for accounting, where we said accounting, the process of recording, summarizing. You remember that, the financial transaction. But now someone will ask, as you are summarizing, for recording we saw, you record in books of original entry, where I gave you the cash books. We looked at sales journals, the purchases journals, among other books of original entry. But after that, the question is, where should we put our financial transactions? We have to carry them from our books of original entry to a certain record called ledger. In other words, putting in ledger, that process is called posting. That is capturing information from books of original entry, then we take to our ledger accounts. People who are out there will ask, what are the ledger accounts? Yes, I have summarized for you here. We are looking at ledger account as accounting records. When we talk of records, they are used to summarize. We are at summarizing stage. That is, we record, and these are records that summarize all the transactions of a particular item or account in business. Now, you look here. Suppose you are making sales. Let me go to manual and we see if you are recording in your books. You have a page where you record your sales. Whenever you make any sale, you go to that page and you record them. Whenever you make any expense, could be water bills, you go to a page for water bills and you record on that page for water bills. If it is electricity, we summarize regarding or a particular account or item. So when we talk of summarizing, we're going to get items or transactions of the same nature. We put or we post them on a specific account. That's why I'm saying these are records that summarize all the transactions of a particular item or account in a business. Where do you get these transactions? From our books of original entry, where you recorded initially, then you have to pick it, you record in a particular record called a ledger account. What we need to know, they help to track financial activity in the business. They track financial activity in the business, such as maybe cash, when you receive cash, when you are paying cash, sales, you've made sales, you have sold goods, we always record on account for sales, we record on account for expense, but individual accounts. You know, expenses are many, as we shall see, but we shall record on individual accounts. Ledger accounts are so important in accounting, in our accounting process, because when you look at this ledger account, they help to show any increase or decrease in a specific asset. Could be an asset is increasing, it will show us. If it is reducing, still it will show. They will show increase in liability or decrease in liability. As well, they will show the increase in income, equity, expenses. By mere looking at your transactions in your books of original entry, you can't know that the sales are increasing or expenses are increasing, or they are reducing. But the moment you look at our ledger, where you have summarized your sales together, where you have summarized your expenses, you can make a conclusion that our sales are increasing, our expenses are increasing or reducing either way. Now here, before we start costing to ledger accounts, it's very important to understand that we have types of ledger accounts. The moment we understand the types of ledger accounts here, they will give us a go-ahead on posting and balancing our ledger accounts. Let's start with what we call nominal accounts. You have heard this before. Nominal accounts, we are looking at our ledger accounts that record the expenses, they record losses, income, gains, among others. So whenever you find any account where we have to record expense, which expense could be electricity, could be transport, could be water bills, among others, that is a nominal account. We record expenses. But doesn't only record expenses, even we record incomes. For example, sales, could be revenue, you have sold the goods where you put that. Doesn't only record that, even losses. Maybe you have incurred loss on sale of one item, then you incurred loss. Maybe you have made some gain. We record on under what we call nominal accounts. Of course, the examples of such accounts I have put for you, we have salaries and wages, that is an expense. We have rent. I'm just trying to categorize different expenses. I don't expect you to have one account for expenses. That will not be summarizing. We said at this step, we have to summarize items or transactions related to a particular account. So don't just come up with one account for expenses. You know, expenses have different types. The way you can see here, don't combine the salaries and wages with rent. No, you open sales, admin salaries account, rent is account, sales account, commission is account, interest, among other accounts in regard to nominal. Don't forget the primary purpose. Before we go to the purpose there, don't forget we record expenses, the losses, incomes. So anything which is not here, but it is an expense, just know that is a nominal account. We need to know the purpose of this nominal account. When we look at our nominal account, is purposely to show the profit. We're going to show the profit or loss of a business during a given trading or accounting period. Now, how do you know the profit or loss? Of course, remember we said they are showing the revenue, that is sales. They are showing expenses. Don't forget in our income statement, we are recording revenue and expenses. So by taking those balances of our income statement or profit or loss, we get revenue, subtract expenses. At the end of the day, we shall know whether the business has made a profit or has incurred what? Incurred a loss. That's why nominal accounts are very important. If we don't prepare nominal accounts, of course, we shall not know whether the business is making a loss or is incurring a loss. Then there is another issue concerning the nominal account which we need to master and understand. The issue of closing. Are we supposed to close our nominal accounts at the end of trading period? Yes, we need to close our nominal accounts. How do you close? We are saying nominal accounts are closed at the end of the accounting period. To profit, this to profit means we have to record or to take those balances to our profit or loss account. Don't forget I said you get sales minus expenses. Now the expenses you are going to subtract, where do you get them from? From our nominal accounts at the end of trading period. We don't carry the balances for nominal account to the next period. We close at the end. If your trading period is 12 months or 1 year, we don't expect you to get the balances for nominal account and you carry it forward to next trading period. We close them. Closing means we take to our profit or loss account. By doing that with nominal account, we shall be able to ascertain whether the business has made a profit or has incurred a loss. Hope it sounds good. Let's try to look at another type called LEO account. Nominal, I believe we okay. Type number 2 is LEO account. These ones are very simple. I think I talked about accounting equation. Whenever someone talks about LEO account, your brain should run to accounting equation. You know, accounting equation shows assets. Of course, assets equals to liabilities plus owner's equity. Now, accounting equation has 3 components. It has assets, liabilities, and owner's equity or capital. So when someone talks about LEO account, remember, Iman said we are referring to accounting equation. Anything in accounting equation is recorded under what we call your accounts. That's why here we are saying these are accounts that record the assets. Where do we find assets in our accounting equation? The liabilities. Where do we find liabilities in our accounting equation? And the equity of the business. Only those 3 items which are catered for under your account. So at this point, even before we start posting, we know, the difference between nominal and LEO. As we are seeing that for LEO specifically, for the items which are included in accounting equation, that is assets, liabilities, and owner's equity. For example, we have cash here. Cash is an asset, that is current asset. We have building, that is non-current asset. Furniture, we have loan and other things. So anything which you find under or connected with accounting equation, like any item of asset, any item of liability or owner's equity, we put or we refer to that as LEO account. Now, someone would need to know what are the purpose. Of course, there are so many, but the main one of this LEO account is to show the financial position, how the business is performing in a given period of time. So we shall see the financial position by looking at our assets of the business, our liability of the business, and owner's equity. That's why their balances are carried forward. For nominal account, I say we close to profit or loss. But these ones, their balances, please don't take them to our profit or loss, but rather you carry them forward to the next period. Of course, they are recorded in balance sheet as well, so that we can determine our financial position. No balance sheet is a statement that shows the financial position, which means we have to take these balances there as well. Closing, someone remember here under nominal account, I said yes, we have gross to profit or loss, meaning we get those balances for nominal account, we record it to or in income statement, and we close, we don't carry forward to next period. But for real accounts, we are not supposed to close our accounts under real. We don't close, but rather we balance, and their balances are carried forward. We carry forward to the next period. Don't make a mistake. We need to understand this very well. I'm saying you need to understand the nominal account and the real account. As nominal account is responsible for recording expenses, the income, the gains, the losses. Don't forget, the account is responsible for accounting equation items, that is assets, liabilities, and owners' equity. 2. Don't forget, nominal account, we close them at the end of trading period, and their balance are carried or are recorded in profit or loss. We don't carry them to the next accounting period. But for real account, their balance are carried forward to the next accounting period. So as we are recording, as we are posting, you are going to see this. When you look at this, someone would ask, how does an account look like? I think I need to talk about this before we dig into the example. An account, if you have checked in the previous videos, I told you, it is in the form of T. Letter T. Format here, if I put the format, it's going to be in the form of T. See, this is our ledger. When I talk of our ledger account, whether it is a nominal account, whether it is a real account, they have the same format. What this format, it has two sides. It has this side called left side, and has this side called right side. And when you look at it, it is very clear. All right, as you can see, our format, I was showing you the format, how our ledger account look like. It is in the form of our letter T. I told you letter T is written like this. So when you look at this, it is in this form, letter T. I'm not talking about the small t, I'm talking about the capital T. When you look at this, it has two sides. It has the left side and it has the right side. Now the question is, what are you supposed to record on debit side and what you're supposed to put on credit side under what circumstance? I have summarized for you this in a simple way by using a table. So let's try to go through this table and we understand what should be recorded. I can understand maybe in your earlier studies, maybe when you are looking at cash book, could be 2-column cash book, could be 3-column cash book. Your lecturer must have told you items which are recorded on the debit side of the cash book. They are supposed to be recorded on credit side of our ledger account. Or those which are recorded in cash book on credit side, then when you come on debit side of the ledger account, that's where you're supposed to record it. And the question is, why is it like that? What about other books of regulatory like sales, where it doesn't have debit side and credit side? How will you record that? We need to understand by looking at the principle how now we should record in our ledger account, and I have simplified for you by using the table. Let's take a look at this table. When you look at this table, it has item, of course, you're going to go to different item. Debit side, where when I put debit side means if that effect is there, of course you put on debit side, and even credit side. So because we are trying to see where you are supposed to record, is it debit side or credit side? Some people have been just guessing where they should record, whether on debit side or on credit side. We want to stop the habit of running in accounting Accounting is not about programming, but it's about understanding the concepts. And once you understand the concept, my students, accounting is going to become so easy when we get to our summarizing in our ledger account or posting to the ledger one, ledger account. Let's look at this table. Let's start with these items already I explained from our previous notes. I talk about increase in asset. Increase in asset. Let's take a look. How do you know that assets are increasing? Suppose you have one item, maybe you have one machinery, then you go and you buy another machinery. We say assets are increasing. Hope it's very direct. Suppose you sell some assets. You had two and you sell one. Assets are reducing. So I'm talking in regard of increase in assets. Cash is increasing. Maybe machinery increasing. Buildings, among other types of assets. The moment you see it is increasing, they can use statement like the business purchased machinery. When you purchase a machinery, of course, your machinery is increasing. How do you handle that? We are saying the moment you see that element of increase in an asset, please debit. That's why I'm putting DR bracket plus, meaning your account, that assets account is increasing. That's why I'm using add DR. Let's look at this side. You come to this account. Suppose this is assets account. You have to record that transaction on this side. You post it here. Why are you posting it here? Because the page says the moment you see an asset is increasing, please you put on the debit side. Capture the date, the item, and amount. You put on this side. Then item can also reduce or decrease. For example, you may find a decrease in the asset. Assets are decreasing. We shall go through how an asset can decrease in terms of value as well in terms of maybe disposing of the asset. So the moment you see that assets are reducing or decreasing, whether in value could be in form of depreciation or it is you are disposing of, you are selling of this asset. What do? You have to go on the credit side. The reason why I'm putting minus, it shows the assets account is reducing. That's why I'm subtracting that amount. We just go on opposite side, where asset is increased or decreasing, you put on credit side, or what we call right side. So a keynote here to master assets, please. When assets are increasing, we debit. When they're reducing, we credit. Hope it's very clear. Let's look at item number 2. Is about expense. Expense could be transport, water bills, salaries and wages, among other expenses we incur in business. The moment you see that expense is increasing, for example, you are paying salaries are increasing. You are paying water bills, you are paying for transport. You see, suppose you are recording, whenever you are spending, you are recording salaries, you have a book where you are recording, maybe you are paying for electricity, you are recording. It means the electricity is increasing in terms of bill. So once you find any form of expense increasing, whenever you make any payment for an expense, please don't confuse yourself which side of the ledger account. You just go and you put on the debit side of ledger account. By putting this plus sign, it shows that account is increasing. We are adding something on that side of ledger account. As well, our expenses can reduce. So when they reduce, what do we do? Should we guess where should I put whether debit or credit or cost? No. We need to know the moment there is a decrease in the expense, please don't look anywhere. Just go on credit side and you record this entry. Then we have liability. Don't forget, I'm building on our accounting equation where we had assets, liabilities, and equity. So I have added even expenses and some incomes. But when you look at our liability, it is opposite to asset now, according to that principle. When liability is increasing liability, maybe loan, you're acquiring more loan is increasing, more bankrupt, short-term loans are increasing, you're acquiring more. Where you have to credit. You have to credit. That is really very important. You put on credit side of your ledger account. Don't forget, those who have just joined the video, we have two sides. I'm saying the left side, that is debit, and credit side, that is our right hand side. So once you see a liability is increasing, please just go on credit side and record it. Don't be confused. Where should I put it? Don't use guesswork. Don't guess. Don't gamble. Here we base on credit. We are saying when the liability is increasing, please just go on credit side and post that entry side. However, when it is decreasing, the moment your account and salability account is decreasing, it means you have to put on debit side of your ledger account. That's why I'm putting in bracket here minus side to show we are subtracting, we are reducing that account. So when it increases, we put on credit. So by subtracting, of course, we have to put on opposite side, that is debit side. Then we have equity or capital. So where you see our equity is increasing, it has the same behavior like liability. Even when you look at the accounting equation, of course, liability and equity, they are on the same side, right? And asset on the other side. So once you see liability and equity, they have the same behavior. If equity is increasing, you put on credit side. The moment you see any decrease in the equity or any component of equity could be retained earnings, you put on debit side. The decrease on debit side, the increase on equity on credit side. Hope even equity is very clear. Let's look at revenue. Could be revenue, income, revenue, sales. Under income could be gains, commission received, different incomes, revenue, sales. The moment you see increase in income, revenue, or sales, same behavior like liability, same behavior like equity. Of course, we credit that account. We have credit. That's why I'm putting the plus. Credit. The moment you see decrease in income, revenue, sales, you have to debit. There is something which is important I want to add here. Something important, something small on this, because even it involves it's called normal balance. Normal balance for that particular item. Remember, I have told you either you put on debit or on credit, but what should be the normal balance for you to make your post your ledger account? Then when after balancing, say, even before forwarding for marking, you can mark yourself that the truth is this is the wrong account. I have not recorded it very well because we have the balances for particular accounts. So the moment you find you expect normal balance to be on debit side, closing balance to be on debit side, then you find it on opposite. Just know there is a problem with your posting. So the normal balance for assets is debit side. Debit side. We expect, if all conditions are okay, the assets account to be having debit balance. That's the normal debit balance. The moment you find it on credit, there is something which may not be moving on well. That's why you need to check, did you post very well? Did you comply with double entry very well? Did you follow all the principles of accounting as you were recording, as you were posting the ledger account? Because we are saying that normal, from today throughout our accounting career, the normal balance for an asset is supposed to be on debit side of the ledger. What about expenses? Yes, expenses have also the same behavior. The expenses, the losses, same behavior like assets. Still, the normal balance for expenses is debit side. What does it mean? We expect you, when you balance your account here, we expect your balance brought down to be here on grade 1, grade side. The moment I find this on the other side, and yet it is an assets account, yet it is expense account, I have to check. Maybe there's something which is not okay. That's why it's called the normal. The other one will be opposite. That's why abnormal. So we need to check why is that balance on the other side. Yet we are saying the normal balance for asset, expenses, losses is supposed to be on the debit side. So we expect to find this on this side. Then we have our liability. The normal balance for liability is on credit what? After recording all the transactions related to a particular liability account, at the end of the period, after balancing, the balance sheet I expect it to be on credit side. And that's its normal balance for liability. So the moment you find BD on this side, yet it is a liability account, it means there is something abnormal. We need to check what is wrong. Maybe you have something abnormal. We need to check and we correct that. You may have made an error in recording, complying with double entry, among others. So even before give your paper for marking, you can mark yourself by using the principle. I might say the normal balance for liability is credit. And for you, as you are balancing, you find it on credit. first go through and you check what is abnormal there, then you correct it. When you look at equity, or capital, they have the same behavior like liability. They have credit, no balance is credit, side, as well as our income revenue, still that no balance is credit side. So you can look at this, how this table is being summarized. And the moment you master this table, you understand what is supposed to be where, maybe debit side or credit side. I can assure you, accounting is going to be so simple for us because this is a stage that is linking us from books of original entry as we cross to final books. So let's try to understand. So that we don't cram, but we should understand why it is done like that. Remember, we started from principle of down entry. So we are trying to play around that principle of down entry. You see that everything we bring it to life. Alright. This example, transaction number one, we want to identify accounts which are involved in there. We have on 1st April started a business with cash 50,000. Meaning you are getting money to invest in your business. You get a point? So now here we have two accounts which are visible. One, we have cash, it is direct, shows that is cash account. You go and you drop that account called cash's account. Anything regarding cash, this involves the cash movement, either coming in or going out, we shall be recording on that account for cash. Then even the money used to start a business, now it has turned into what? Into capital. That will become capital for the business. We are going to open capital's what? Capital's account. You come here, you draw the capital's account. Can even summarize like this. Capital's account, and we have cash is what? Cash is account. Comes very simple. Now, when you look at our two accounts, don't forget from our table here, we say when an asset is increasing, where do you record? Of course, we are recording on our debit side. When a liability is increasing, we are putting on the credit side. Take an example here. We here don't have liability, but we have equity, or that is capital, and we have cash. And here, for asset, we said if an asset is increasing, you are putting on the debit side. And if our equity is increasing, we are going to put on credit side. It becomes very easy. So here, what we are going to do, we have picked cash, we bring in business, and we create what we call an asset called cash. Meaning, our cash is now increasing. We need to bring and record on the debit side. We are increasing to capital. It matches in the account where, remember I talked about number entry. Don't forget each entry must affect two, or each transaction must affect two accounts. So here the detail we put must be in the correspondence with the other account you're going to put. That is how much? 15,000. Even when you are not sure where to put this record under capital account, suppose you are not okay with the other table yet, and you are not sure, but the moment you identify the first account correctly and you have put on debit side, automatically the corresponding account must be on credit. But this implies that now even the capital account for the business is increasing. You have turned your cash into capital. So you have capital 15,000 on the same date, 24. Capital from where? From cash account. How much? 1,000. The moment you post or you record our entry or our transaction like that, one, you have complied with the principle of our entry. That says for each transaction, for each entry, we must have both debit entry and credit entry. Hope that is really very clear. Let's look at our transaction number 2. Transaction number 2, on 4th April, purchased furniture for 3,000 in cash. Now you are purchasing furniture. Here you can identify two accounts. One, we have furnitures account, and we have cash's account. I told you, the moment you identify the accounts, of course there must be two accounts. But after identifying, you draw what you don't have. For example, I have already the cash account. It's there. So you don't need to go and withdraw another cash account. You will be making a mistake. What do? You draw what you don't have. Anything related to cash, we record here. So we are going to draw here our furnitures account, furnitures account, ah, furnitures account. Now the question is, first of all, cash is an asset. Furniture is also an asset, non-current asset. Now, when you buy, you purchase, buying, purchasing is buying, you are buying furniture. It means your furniture you had, if you had it two, now you have three. If you had it four, now you have four. Your furniture is increasing in business through acquisition. So when an asset is increasing, we say we call it all the side. As well, when our asset is reducing, we put on opposite side. So when you buy furniture using the cash, you are getting your cash from your cash's account, you take to the market or the supplier, you buy the furniture. Furniture is increasing, cash is reducing. To show that, you just come here and put on four. Four. Furniture is increasing with from which account? Cash. You have used the cash to buy furniture. How much? That is 3,000 US dollar. 3,000. As furniture is increasing, your cash is reducing. Why? Because you are using the cash to buy furniture. So you can't have furniture at the same time you keep your cash. Cash has reduced, and as cash is an asset, we say the moment asset is reducing, we have to put on credit side. So you capture the same information you are seeing here, same day. You put for April 2024. Cash is reducing to which account? Reducing because you are buying furniture. You put in your furniture. How much? 3,000. Still, by doing that, you have compromised double entry. We have this 3,000 on credit side and we have 3,000 on debit side. Why? Because furniture is increasing in an asset, we put on debit side. Cash is an asset and is reducing, we record on credit side of our ledger account. That's our transaction number 4. It's number 3. On 7th April, sold goods worth 8,000 on credit. You see now, if you were recording in cash book, you wouldn't record this in the cash book. But it must be posted in our ledger account. You can't ignore and leave it outside there. Whether it is a cash transaction, whether it is credit transaction, must be posted to the ledger account and be summarized there. And the most important thing here is identify. We have sales account here. We are selling goods. Create sales account, and even we have to HANA. This is account receivable. Account receivable. Hey, but since even they have told us that that's HANA, we can create, it's really very important to create the individual accounts. You can open HANA's account and sales account. Come here and create sales account. Create sales account, and we shall create HANA's account. Put the and you put CR. Now, when you sell goods, when you're saying you sold the goods on credit to HANA, there is something here you need to understand. Our total sales you find in our profit or loss or account or income statement include 2 items. One, we have cash sales and you have credit sales. So it does not matter whether you have sold on cash basis or on credit basis. Once you make a sale, your sales are increasing. So the moment sales are increasing, where do you record? Of course, I told you, when it sales, revenue, income are increasing, you have to put on credit side of that account. As well, when they are reducing, you put on debit side. HANA is our receivable. Account receivable, that is an asset, current asset. When asset is increasing, we put on debit side. When it's reducing, we put on credit side. Don't forget that principle. The moment you master that principle, recording opposite ledger account becomes very simple for us to handle. Let's take a look here. Sold the goods on credit to HANA. When you look at that transaction, meaning our sales are increasing, and as they are increasing, we put on credit side of sales account. And HANA is an asset. As HANA receivables are increasing, we put on debit side. So you capture the debt. That is on 7th April 2024. Sales are increasing to receivable, that is HANA, capture the name of that video account. How much? 80,000. Complete double entry by going to another account and you put on opposite side. If this is on credit, automatically HANA, since the asset is increasing, we shall put that transaction or that entry on our debit side. Receiving sales, yes. How much? 80,000. That one also becomes very easy and direct. We have to comply with double entry. Each transaction must have two accounts affected, of course, both on debit and the credit side of such particular account. Let's look on 10. Received 5,000 in cash from HANA. Good. From our previous here, you sold the goods on credit to HANA. Are you seeing this? We sold the goods on credit to HANA. But that was on 7. After 3 days, HANA is behaving well, is a good account receivable, is a good data. After 3 days, she came and paid 5,000. Now here, which accounts are involved here? One, you have cash. I'm seeing you are receiving cash. You have cash's account. Cash is being affected by increasing. We shall see that. And you see here, HANA's account now is going to reduce. So here you come. That is on 10th. You look for accounts which are affected. That is cash's account and HANA's account. Already they are there. Don't draw. No one is supposed to have more than one account. If it is HANA, she must have only one account. If it's cash, must have only one account. We don't expect you to have like 4 accounts in regard to cash. That is not allowed and it's very wrong. We don't expect you to have like 5 accounts for HANA, referring to one person. So the moment you have the account, don't draw them again. Just pick the information and affect those accounts. For that case, HANA is paying, cash is receiving. Our cash is increasing. When someone pays, you are receiving cash. You come here on 10th, cash is increasing. From HANA is paying, right? How much? Paying 5,000. Our account for HANA, our receivable is now reducing. Same date. As the asset is reducing, you have to put on credit side. So you come here and you put reducing to cash. You are paying with cash. That's why your account balance is reducing. By how much? By 4,000. Good. We can try to look at another transaction that is on 14th. On 14th, paid 1,200 rent in cash. Now you see, you are using your cash to pay rent. Very beautiful. You just get cash. Maybe you have already your cash account. You pick cash and you pay rent. That means cash is reducing because you are using it to pay rent. However, the rent account is increasing. Rent is an expense. Cash is an asset. They have the same behavior. As rent is increasing, you debit it. As it is reducing, you credit. Same applies to cash. As cash is increasing, we debit that account. As it is reducing, we shall put on credit. What? On credit side. So we are going to our cash account, we reduce it. How do you reduce? By recording it on credit side. That is on 14th. Cash is reducing to rent because you are paying the rent. You are using your rent, your cash to pay this rent for the business. How much is it? That is 1,200. Don't forget double entry. The moment you put it here, you must record it somewhere in another account. That is rent's account, and I don't have rent account. You can create rent's account here. And still, we have DR, we have CR. So as we put rent on credit side of cash account, here automatically it will come on debit side because it is increasing and it is an expense. We already explained this. Increasing cash, how much? 1,200. Let's look at another transaction here on 16. 16, purchased stock worth 4,500 on credit. Now, here they told us you bought on credit from Hannah. Here they have not told us where you have bought it from. The moment they don't identify where you have bought it from, we shall identify two accounts here. One, purchases. We have purchases here. Hope you can see this. Here on credit, it is going to create what we call accounts payable. Accounts payable. If this supplier was mentioned, maybe from John, we would put John, but since we don't know the supplier, we can open what we call accounts payable account. So let's start here. You can put purchases account, we have BR, we have CR, and you can have accounts payables, account. BR, C. When you purchase goods, what happens? Don't forget, I told you the expense. If they're increasing, we put on the debit side. And purchases, those are expenses, of course. So we are spending money to buy stock for the business, right? So we are going to put on the debit side of our purchases. Then the accounts payable, since it is our liability, and I don't know when liabilities are increasing, we put on credit side. Simple. You record and you move on. So that is on 16th. Purchases are increasing, so we put on credit side. On purchases, increasing to accounts payable. Accounts payable. How much? Accounts payable by 2,000. Yes. I think it's not 2,000, it's 4,500. 4,500. Accounts payable is also increasing. Our liability is increasing by those purchases. So we shall create here deposit entry to purchases. How much? 4,500. Finished. Then we can look at another entry here. That is on 20th. Paying salaries in cash. We are paying salaries in cash. This is very direct. We have two accounts: the sales salaries account and the cashes account. Already you opened an account for cash. You don't need to open another one. Just take this one to cash's account. But for salaries, it seems like you have not yet opened. You have to open another T account for salaries account. So you come here and open what you don't have. Salaries account. I told you open what you don't have. Already we have cash's account. Now my question. When you pay salaries, is your cash increasing or reducing? Of course, you are getting cash for the business. You are using it to pay workers. So your cash you had on your account is reducing. However, the salaries account is increasing. So as cash is reducing, this is our asset. As asset is reducing, don't forget, decrease in asset. What do? You credit. You record on credit what? On credit side. Decrease in asset. So cash is an asset. Cash is an asset and it is reducing. Meaning, we are going to record it on our credit side to reflect a decrease in cash. Decreasing to what? To salaries. How much is it? Decreasing to salaries. How much? That is 2,000. Don't forget, complete double entry. By recording there under cash's account, you look for the respective account as well. Then you record on opposite side. Salaries is an expense. And I told you, when you look at our table here, when an expense is increase in expense, what do? You debit. Why? Because we are adding that account is increasing. So you have to come the side and you record same date. Salaries. Not salaries. Increasing cash. How much? I'm taking this entry, 2,000. Finished. Then we can look on 30th April. That's our last transaction. Sold the goods worth 3,500 for cash. When you sell goods, cash is increasing, sales is increasing. So what do? You go back to our principle. We say when sales or income or revenue, sales are increasing, you record on which side of that account. And when cash is increasing as well, we put on debit what? Debit side. So since you are receiving cash from your sales, you come on debit side of the cash account, that is on 30th, 2024. We are going to receive cash from where? From sales. How much is it? That is 3,000. 3,000. You go to sales account as well. You look for sales account. You must be having it somewhere. Yes, it's here. Don't forget, in this sales account, at first I recorded the handle. Where you find that we had sold goods on credit, she didn't pay, but we recorded it there. This one is cash sale, but still I'm going to record the same account. Don't open two accounts for sales, whereby you have cash sales and the credit. No, you all put in one account sales. So this sales was on 30th, 2024. Sales account is increasing. Cash, how much? 3,500. That is, we are required to post this transaction to the ledger account. It was just posting. This is our first video on posting to the ledger account. The question is, should we stop here? No, I told you accounting is a process. As we started recording books of original entry, now we are posting to ledger accounts. From there, we are going to learn how we can balance these ledger accounts. Then we transfer and extract what we call trial balance to see, we test the correctness, the accuracy in our principles, whether we have done the right things. We can only discover that if we prepare trial balance. Don't forget, our next video is about trial balance, where we're going to learn how to balance the ledger accounts. From there, we transfer trial balance to try to test the accuracy of our posting in the ledger. Thank you so much. Keep yourself with ProAccountingAcademy. Don't forget to share. Don't forget to comment. Don't forget to subscribe and like. More videos are still coming. Keep yourself with us. See you again in the next video.